which requires that assets should always be equivalent to what? Capital plus liabilities. Okay, this is it. Now we have said that the accounting equation states that assets should always be equivalent to capital plus liabilities, which means that at each point in time within your organization where you're keeping proper accounting records, every transaction which occurs within your accounting records, once you book them in your accounting records, at that point in time, the value of the asset should always be equivalent to what? The value of the capital plus the liabilities of that particular organization. So in order to move forward with the double entry principle, we're going to look at the basic requirements of the double entry accounting principles. Now I've explained that knowing that the accounting equation requires that assets should always be equivalent to capital plus liabilities, let us now focus on understanding what the double entry accounting principles requires from an accountant or from a financial accountant. Now, in order to apply the double entry principle, you should understand that every account or individual ledger accounts within a company have what we call every expense or every item within the organization have what we call an individual ledger account. Now this individual ledger account looks like a T. Now you've seen I've drawn a T here, and on this T I have named the left side as the debit side and the right hand side as the credit side. I've explained that debit here, D arrow here represents what we call debit, and C arrow here represents what we call what? The credit. Now, if you're passing an entry on the debit side or on the credit side of a ledger account, which is a T account, it will depend now on whether it's an asset account, a drawings account, or an expense account, or whether it's a liability account, income account, or equity account. Now, I have explained that the double entry principles requires that if we are dealing with an asset, if the value of an asset account, drawings account, or an expense account is increasing, then what should we do? We should debit it. So double entry principles require that all increases in assets or drawings and expenses should be debited in their respective individual ledger accounts. Now, if we are witnessing a decrease in asset, drawings, or expenses, the same double entry principles requires that if we have a decrease in asset, we should credit. If we have a So we're going to have a working example of this so that we understand how to apply the double entry principles in reality. Like I've already explained to you, just take note of all these basic principles relating to assets, drawings, expenses, liabilities, income, and equity. So let's look at this example. We have Dicalo Consulting Group engaged in the following business transactions. Now we are saying that these are business transactions which occur in a company called Dicalo Consulting Group. And now we are saying that let us first of all, whenever you realize that a transaction has occurred in the business, as an accountant, you know that that transaction is supposed to give rise to a dual effect, or is going to have an effect on two different ledger accounts. The very first thing that you need to do is to identify the ledger accounts that are involved. For instance, item number 1 here says that Dicalo Consulting Group issued common shares. Common shares is something like what? Ordinary shares. Now, whenever the owners have, since they have introduced or they have issued ordinary shares to themselves, when they issue ordinary shares to themselves, they need to pay through cash. Because you understand that we have a special the business entity concept, which states that the affairs of the owner must be treated separate from the affairs of the owner. So when the owner of a business introduces 500,000 or 5,000 US dollars into the business in the form of common shares, by acquiring common shares, it is going to affect two different ledger accounts. The first ledger account here is what? Equity account. So we open a ledger account, debit and credit for equity account. So you open a ledger account for equity account. Now you know that this is your equity account. Now at the level of the equity account, according to our double entry principles, they were saying that if equity is increasing, what are we supposed to do? If equity is increasing, we should credit the equity account. So since we have opened our equity account, what are we supposed to do? The 5,000 needs to be what? We credit the equity account with 5,000. Now, like I've explained, we have agreed that every transaction will give rise to what? Two effects on the account, on our accounting records. The second ledger account is that the owner of the business has invested $5,000 by taking ordinary shares or common shares, which means that the business is receiving what we call cash. You open your cash account. You open another ledger account here, which should be representing what? The cash account. We have here the debit side and the credit side. According to our double entry principles here, they stated that if the value of asset, we know that cash is an asset, and I explained that cash are those resources that the company is controlling as a result of a past event. So the owner of the business has actually acquired shares by introducing in how much? $5,000. So since we have debited, or we have credited the equity of the owner by 5,000, it means that the value of cash, the business is receiving cash. So what are we supposed to do? We need to equally credit, we need to debit our cash account with how much? With that same 5,000. Why are we debiting with 5,000? We know that cash is an asset and the value of cash is increasing, which is an asset, and already we know that according to the double entry principles, increases in assets should be what? Should be debited. That is why we are debiting the cash account, and we are crediting the liability account, which is a special liability account, which is the equity account, because of the fact that we know that we have received money and the money does not belong to the to us or to the business. The money which has been received is owed to the owner of the business. That is why we have credited the equity account. Now let's go to the next transaction. The next transaction here states that bought equipment for $3,000. All transactions here, we assume that they are on cash basis. Now they are saying that if we have bought, Dicalo Consulting has acquired equipment for cash of $3,000, it means that there are two ledger accounts that are going to be involved. The first ledger account will be what? Equipment account. Equipment account. We're going to have what? Debit side and what? The credit side. Now the asset was actually a cash, will be reducing by how much? By 3,000. And we already know that if assets are increasing, we should debit. If assets are reducing, we should do what? Credit. So since we know that we are buying this asset and paying cash, it means that since we already have a ledger account here for cash, once we make the purchases of this asset for 3,000, we are going to credit our cash account. Why are we creating our cash account with 3,000? We are creating our cash account with 3,000 because we know that the value of cash will be reducing, and at the same time, in order to respect our double entry principles, since we have credited in the cash account, we need to debit in another account, which is what? The equipment account, and we need to debit also by how much? 3,000. Lassie, I'm doing something. You're talking.
Because you stop now.
No, I'm.
You did stop.
See the film, no? Yeah, you have to make, this is double entry, you have to bring together, otherwise nobody will understand.
No, I will know how to check.
So just wait, very soon I should take it, I'm working the examples, 2 finish, 3 balance. So now already we are done with, we have treated the first 2 transactions of Dicalo Consulting, which is what? Issue of common shares and acquisition of what? Equipment for $3,000. We have agreed that since the owner of the company issued shares of $5,000 in the company, it means that the business was receiving cash, and that is why we have debited our cash account with $5,000. And we have said that, okay, since this business has received this cash of $5,000 and the cash does not belong to the business, it means that the business needs to recognize the fact that they are owing that $5,000 to the owner by crediting what we call the equity account, because equity is increasing and double entry principles have said we should credit. And the second was that we bought an equipment for $3,000, and we know that if we have bought an equipment that at the beginning of the business we had no equipment, it means that the value of an asset, which is cash, we are buying an equipment and paying for it by cash. It means that the value of cash is going to reduce by $3,000, and that is why in our cash account we have credited our cash account how much? With $3,000, because we know that cash is an asset, and since it is an asset, the value of cash should be reducing. And at the same time, we have debited our equipment account with how much? With $3,000, because equipment is a non-current asset and the value of asset is increasing. Now let's look at the third example here, the third transaction, which was carried out by the Dicalo Consulting Group. Here the transaction was like bought inventory of what? $1,000. $80,000 of this was paid in cash. The remainder is outstanding at the balance sheet date. Now we're going to realize that we're going to have so many more than 2 effects here now. Now we are saying that what? First of all, we bought inventory. Inventory is what? An asset. So the very first thing here is that we need to identify the ledger accounts that are involved. The first ledger account here is what? We need to open a T account for what? Inventory account. And when we open an account for inventory account, we should have a debit side as well as a credit side. Now they are saying that out of this, we bought this for $1,000 and we paid 800 was paid by cash, which means that we equally have what? This 800 is going to affect our cash account. Now if we bought inventory for $1,000 and paid 800 cash, it means that the value of our cash is going to reduce by how much? By 800. So you credit your cash account with how much? With 800. Why? Because cash has reduced. Now what do? The value of your inventory is an asset, and if assets are increasing, it means that what? We need to debit the asset account. So the full value of the 1,000 which we actually spend in the acquisition of the asset or in the acquisition of the inventory will be debited in our inventory account. We debit the value of inventory account with 1,000, and then at the same time we credit the value of our cash account with 800. Why? Because of the fact that we bought this inventory for 1,000, but we did not pay all the money. We paid only how much? We paid only 800. Now if we have already debited 1,000 and we have also credited 800, which means that there's a difference of how much? 200, which we still need to account for it. Since we have debited 1,000, it means that according to the double entry principles, for us to respect them, we equally need to credit how much? 1,000. But we have only credited how much? 800. So when we buy goods on credit, it means that we are owing the supplier. That is why we open what we call a payables account or suppliers account. And in this payables account, we know that payables is increasing. So what are we supposed to do? We credit how much? With 200. At the end of the day, you realize that we have debited 1,000 in inventory account, and at the same time we have credited payables by 200, and then we have credited our cash account with how much? With 800. At the end of the day, you realize that we are respecting the double entry principle because we have debited 1,000. At the same time, we have credited how much? 1,000, even though the effects are different. Now let's go to the next example. Now they are saying that the fourth example, they are saying that sold 75% of the inventory for 1,200. 100 of this had been received. 1,000 of this, it should be 1,000 and not 100. You know, it's just a hypothetical example that we're using to illustrate this so that you can better understand what we're doing here. So now they are saying that 75% of the goods which we actually acquired, well, now on the fourth transaction which occur. Now they are saying that 75% of the goods which we actually acquired were sold for 1,200. So if you want to get 75%, 0.75 multiplied by the value of the goods, which was 1,000. $75% of the value of the goods, which was 1,000, means that we sold goods costing how much? $750 for how much? For 1,200. Okay. Now they are saying that so if we sold goods of 750 for 1,200, it means that since this sales transaction, and they are saying that 1,000 of this had been received in cash at the balance sheet date. The balance sheet date is a date at which you are required to prepare and present your financial statements to the users of the financial statements. Maybe at the end of the month that you want to do your month-end closing. So since we have made sales, it means that in this transaction number 4, first of all, since we have made sales of goods, we are going to create what we call a sales account. Sales account, in the T form. We are going to have a debit side as well as a credit side. Now they are saying that when we sold these goods, or we received part of the was received cash, 1,000 was received in cash, which means that 200 was on credit. Now you should understand that when we sell goods on credit without receiving payment, it gives rise to what we call debtors, what we call receivables. Receivables are simply those customers which have bought goods from the company but have not paid. So now, since we sold goods, and you know that sales is an income, and the value of an income is increasing, what are we supposed to do? We credit our sales account with how much? 1,200, which is the total sales revenue that was generated or that was realized from 50% of the goods as at that period in time. Now when we credit our sales account with 1,200, now they are making us understand that when we sold these goods for 1,200, we receive cash of how much? 1,000. So since cash is increasing and cash is an asset, we debit our cash account with how much? With 1,000. Now we realize that we have credited already how much? 1,200, but we have debited just how much? Just 500. Just 1,000. Now we are saying that since we sold goods for 1,200 and received only 1,000, it means that we create a special type of account which is what we call receivables, or what we call debtors. These are people who have bought goods and are owing us. So the value of our debtor here will be what? Equivalent to the value of the total sales which we made minus the cash which we received. We received just how much? 1,000. So 1,200 minus 1,000 is how much? 200. So it means that at the end of the day, we are going to open a special account which is called what? The receivables account, and then we have what? We have the debit side as well as the credit side. And since we have realized that it's an asset account and the value is increasing, what are we supposed to do? We debit the value of the receivables account. At the end of the day, you realize that cash receivables, we have debited how much? 200 plus the cash which you receive from. And how to close these various individual ledger accounts. Remember, at the end of the period, we are going to close the various individual ledger accounts which we have created for all these expenses, assets, liabilities, equity, incomes. At the end of the day, we are going to close these balances and transfer the balances to the general ledger. And then from the general ledger, we are going to prepare our trial balance. And then from our trial balance, now we can then prepare our financial statements. So I'm calling upon everyone to follow up on to subscribe to the channel and follow up on the next video that will be updated, as it will help us to see how to close these individual ledger accounts which you have already created here, and then how to transfer this individual the balances at the end of the day or to the general ledger. And from the general ledger, now we will learn how we can extract our trial balance and how we can prepare our financial statement. Once more, thank you for spending your time in attending this session, which was mainly focused on teaching our accounting users on how to better apply the double entry principles. On behalf of Dicalo Consulting, thank you once more and have a nice day.